All right, guys, welcome to this section. As you can see, we have a very, very special guest, our very in-house tax and legal instructor, so to speak. And we got Mr. Hamilton here on the line. Say hi, Steve.
Hi, thank you guys for having me.
Yeah, no problem. So obviously, Steve, as we mentioned, this is part of the owner financing class. And so I was kind of hoping to shoot off some questions at you so that our students can kind of get more of an understanding on the tax aspects of seller financing. So the first question being, obviously, seller financing is a very popular topic in the world of real estate investing. I'm sure it's not your first rodeo when it comes to understanding what owner financing is.
So, I actually one of my first deals I actually purchased with owner financing.
Oh, no way. Yeah, right on. Yeah, very cool. So Steve, why don't you kind of start off with some general idea from a tax perspective, from a CPA perspective, what is seller financing?
Seller financing, from a basic standpoint, is the seller essentially acting as the bank. So instead of me going out and getting a mortgage with some large institution, I can arrange for the seller to allow me to make payments on a monthly basis or quarterly basis in some cases, depending on how you negotiate. You would pay them interest, you would pay their payments, you could set up an escrow, you would not set up an escrow. But one of the big advantages is you don't have to go to a financial institution, you don't have to worry about running your credit, you don't have to worry about it necessarily being reported as another loan on your credit either, which can really affect your debt to income ratio.
Yeah, absolutely. So from a tax aspect, let's get a little deeper here. What incentives are there from a tax perspective for a seller to sell on seller financing?
Well, there's actually quite a few. One of the biggest ones is either getting a higher selling price or possibly higher interest income. Let's say I'm in my 70s and I want to sell a property, but I know it's going to be a lot of gain all at once. Well, I may actually arrange for seller financing so I can, in essence, get an annuity payment if I want it. It's a nice way to income replace or transition from rents to an ongoing payment. I can spread my gain out over multiple years or give myself enough room to plan for one large gain in a certain year.
Yeah.
So let's say I'm relocating or I know I'm retiring in 2024. Well, if that loan balloons in 2025, that's perfect because then I don't have to worry about that gain on top of my higher income. It gives me flexibility to tax plan, which is where we really save our dollars.
Yeah, and you said something there, and I know that's what you preach a lot. You preach flexibility. Put yourself in a tax situation or a financial situation, really, where you can be as flexible as you want and you can make the choices. I love that. So I think that refers a little to what you and I both actually hear a lot out there when it comes to seller financing, which is, tax deference. Could you speak a little bit more on that?
It is tax deference more so than avoidance by any means. We're not going to change the fact that you're going to have that gain. It's kind of a pay me now, pay me later type of situation. But I have the ability to stretch out, instead of adding, say, $100,000 to my income this year. If you're paying me over the next 5 years, I'll only have $20,000 of gain each year, which means less outlay in taxes. It might even keep me from going up a tax bracket or two. And that's where we see some of our biggest changes. Everybody's always terrified about their tax bracket. Everybody's terrified about their tax bracket. So if we can plan around that, I have the ability to work with a client or even the buyer and seller to structure a deal in a way that will allow them to plan for both sides. Because usually it comes down to the seller not wanting to take the tax hit on a large sale. So we might structure it in a way where they might be able to maneuver their funds into, say, a 1031 exchange, or depending on how the whole deal is structured.
Yeah. Wow. Yeah. Excellent. So, tax deference, you spoke a lot on that. If I may ask you, why is that? Why does seller financing allow individuals to defer their taxes?
Well, it's the nature of what's actually called constructive receipt. And you'll hear me talk about this a lot in real estate, so I'll explain what it is. Constructive receipt is actually when I have a right to receive those funds. and I actually have access to those funds. So I might say, hey, you owe me $50,000, but until you actually write that check, I don't have a receipt of it. So, but you might write that check, but don't put it in the mail. I don't have those funds accessible to me. But once that check is in my hands or it was postmarked, I now have the ability to see and use those funds. So you'll find a lot of business owners try to write a check right before the tail end of the year to get an expense in. It's a similar concept. If you mail it on December 31st, it's going to be a bit borderline. But if you drop it off on December 31st, well, now that person receiving the check had access to the money. So it's about when you physically receive it. So I mentioned a 1031 exchange a few minutes ago. A 1031 exchange works only because of what I just mentioned, constructive receipt. By using that third-party intermediary to receive the funds from the sale, I'm standing over here and I don't actually receive the money yet. So my sale's not yet complete. So by putting the funds in their hands, I can delay that time where I actually receive the money and report the gain. So let's say I enter into a 1031 exchange in December of 2018. What would have happened is I might be looking for a property. I might end up with a property under contract, but let's say I never actually end up buying a property. When do you think my sale was completed?
Probably, well, in that case, if the property was never, if you never bought a property, then I would probably have to say still December, right?
It's not. Because that intermediary is holding those funds, and I truly did actually look for a property, I can then argue that I did not receive the funds until 2019. So I would actually report my gain on my 2019 tax return, which would, the intermediary would hold it for about 6 months. But at the end of that 6 months, I then have until the next April 15th to cut that check.
Okay. That makes a lot of sense. Okay. Wow. That's fantastic. See,
So
I mean,
it's a tool.
yeah, even I'm learning in these classes, you know, that's why I really designed this curriculum. Yeah. So, okay. So, wow, man, that's a lot of really good information there. Really, really good information. So,
Deference is just kicking the can down the road. That's all it
yeah.
really is.
Yeah. Okay. Right on. Right on. So you mentioned that there's a lot of tax benefits for a seller to sell on seller financing. And, you know, I think when we're going over this class, a lot of the students are obviously going to be buyers for the most part. So why don't you tell us a little bit more in terms of, you know, what do those other benefits look like from the seller's end? And my follow-up question, well, actually, let's go ahead and ask that question first.
Well, let me throw this at you.
Yeah.
Let's say I'm going to buy a property from you for $100,000. I want you to finance the whole thing. Have you ever looked at a 30-year mortgage and seen how much you actually end up paying for that property?
Yeah. Yeah, the truth in lending statement.
It's more than twice the purchase price.
Yeah.
A 30-year mortgage, almost 3 times. So, what if I said $100,000, I'll make payments to you, and you know at the end of time you're going to end up getting over $200,000. Do you want $100,000 or do you want $200,000? Or let's say it's a 5-year balloon. Do you want $100,000 or do you want $140,000? I have those options.
Yeah.
Another thing you can also do is an interest-only loan, which can be very lucrative. Interest-only with seller financing delays that tax burden because the funds aren't actually received. I haven't received any principal in there yet. So I can actually push most of the gain. I will still have some recapture potentially, depending on what I've depreciated on the property. But in reality, I can push most of that gain down pretty far because I haven't received any actual principal payments. Or it also depends on how much financing I have on the property as well.
Yeah. Right.
So it depends.
Yeah. Which actually is the correct answer for a lot of situations. You know, unless it's a very specific scenario. You know, a lot of times it does depend on the person's financial status and, you know, where they're at. So you mentioned a lot in this interview. You know, the funds, where the funds are, whether they leave or where are they being held. So in that case, in terms of the tax implications, what about the down payment? if there's a down payment in seller financing, how does that get treated?
The down payment is considered part of income to the seller. And what happens is that payment gets split up between your return of basis and capital gain. That's the simplest part. Now, if it was an owner-occupied property and they were selling the property, then we would be looking at a very simple calculation. You have your return of principal, so your basis in the property, and then you would have your capital gain portion. So we have to calculate out what's called gross profit percentage. And I was trying not to get too technical when just for this quick interview here, because believe me, I could spend hours going on in detail about it. But your gross profit percentage is essentially what percentage of each payment is going to be gained. So I'll use the example of I have a property that I paid $100,000 for. I didn't rent it out. I just sat on, say, the piece of land for a year, a little over a year. And then you want to buy it from me because you want to develop on it. Well, okay, I'll sell it to you for $150,000. What percentage of each payment is going to be profit? The actual calculation is going to be 1/3. So 1/3 of each payment that you give me is going to be profit. So
yeah. And so I know a lot of people.
Way to calculate it.
Yeah, absolutely. So I know I mean, obviously I'm very familiar with what a basis is, but could you kind of let our students know, break it down for us. What is an internal basis? What's that you mentioned just now?
Okay, there's your basis, then there's adjusted basis. So I'll use that example buying a $100,000 property. If I buy a $100,000 piece of land, I'm not going to be taking depreciation on it. I can't depreciate the land. So my basis is going to be $100,000. But let's say I buy that land and I pay to have it entirely regraded. Well, that cost for regrading it is going to be added to my basis in the land. So let's say I paid $10,000 for that small piece of land. So now my basis is $110,000. So it's my total cost of that piece of property. Then we have what's called adjusted basis. Adjusted basis is after I take depreciation. So I'll use the example where let's say I buy a piece of property for $150,000 and I allocate $50,000 of that purchase price to the land itself. So my building cost is $100,000. From that building cost, I am going to be looking at taking about it's $3,636 of depreciation per year. I'm going to ignore cost segregation or those questions for right now. Just looking at the building value of $100,000. So I'm going to decrease my cost in that property by $3,600 each and every year. So if I have it for 10 years, I've decreased that $100,000 by 36,000. What did I say? 3636 times 10, 36,360. So subtract that from $100,000. You're looking at 63,640. That's the number that I'm then going to use to calculate my gain from. So I have to look at the depreciation that has been taken or could have been taken. The tax code actually requires you to take depreciation. If you don't take it, you could end up in a use it or lose it situation. Now, I argue it in audits all the time, and we get credited typically for what wasn't taken at that time. So
yeah. So 3630 is that just 100,000 divided by 27.5?
Pretty much. That's the basic calculation.
Okay. I was gonna say, man, like, did you just do that in your head? Like, that's.
It's a frame of reference. I have it all the time, so I know every 100,000 is going to be about 3,600 in depreciation.
So really, then, for your adjusted basis, you take a number, the value of the property, not the land.
Correct.
And you divide it by 27.5, and it sounds like every year you just subtract that amount.
That's correct.
And that basis gets adjusted every year.
There is a percentage table that we use, and it varies a little bit, but yes, as a straight line method, that would be your easiest way to know it.
Awesome. So obviously, when it comes to owner financing and adjusting your basis and figuring out the depreciation, we probably want to rely on more of a professional, on like a CPA, Always want to get it double checked, you know, and even if we're right, even if we have all the information and we've done a lot of research, you know, even me, I mean, obviously I have my CPA look over it. So in your recommendation, Steve, what are some key indicators that, you know, people as real estate investors, as students of our Kwok Brothers education community, what should they look for when they're hiring a CPA when it comes to their real estate?
Ask them if they invest in real estate. Ask them if they own their building. Ask them what their background is in real estate. Representative Pete Stark out of California had actually made a statement that was, it specifically was, it would take a genius to invest in real estate and still pay taxes. Real estate is one of the most tax advantaged items in our code. So if you find an accountant who doesn't like real estate or thinks that you are, if they say you're an idiot for investing in those rental properties, run away fast because they don't understand. Now, that's not to say that your investment choices weren't terrible. But what we want to do is we want to make sure that they have an understanding of the advantages that the tax code affords them. If I buy Microsoft stock, I can't do a 1031 exchange with Microsoft stock.
Yeah.
So I don't have that option. I don't get to take depreciation on the Microsoft stock. So there's different factors that I definitely want to look at when planning. But that would be my first question if they invest in real estate. The second one would be ask them about depreciation. Ask them about 1031 exchanges. If you hear a lot of, let me look that up, well, then run away. Run away. They should have a basic knowledge of things. Now, I'm highly active in a lot of tax groups online. And I hate saying this, but I tell a lot of people all the time to Google it just to get at least a base knowledge to ask an educated question. So there's a lot of accountants out there that hanging a shingle who really don't have a clue as to what's going on. Some of your best bets are going to be look at someone who specializes in real estate. If they specialize in real estate, they will have a good grasp of most other topics. So if you have a small business, if you have a couple other entities, if they understand real estate investment and real estate taxation, they will be able to, even if they don't specialize in it, they will be able to pick up on those other items very easily. So you already have somebody who's going to be at the higher level of knowledge by looking at someone who specializes in real estate. Now, I have posted several lists of questions to ask an accountant, and there's a wide variety of topics in there. Talking about continuing education. I myself, I teach a lot of tax continuing education. My wife teaches as well. But I've compiled lists asking specialty, what did they study in school? Ask about how many clients they have. Do they actually have room to take you on? Or are they still starting their practice? Now, they might have a few clients, but if there's an explanation why, well, I just started my practice 3 years ago. Well, then you know that they're just getting started out. But that can lead into questions. So what do you do when you have a question? Well, me, I have a whole support network of professionals across the country that I network with. I don't do a lot of foreign income issues, but I know who to call when I have those questions. So ask about their credentials. Ask about business structuring. See if they're in their office all year long. I know a lot of people who just work seasonally. So do they email? Do they have an accessible calendar? What are the options? I have a digital calendar. If you wanted to schedule an appointment with me next week, you could click on and see if I have an availability next week. So how savvy are they going to be? And I hate saying in the tax and accounting profession, the average age is not very young. Most of the conferences that I attend, I'm actually one of the youngest ones in there. But I'm also one of the individuals that people come from across the country to ask questions from, whether it's real estate or retirement accounts, all day long. So,
yeah,
what
absolutely.
questions you have for me?
Yeah, so I know you have a lot of resources that's very public out there. Obviously, you do share a lot of those online. Let's do this. Let's do this. So for our students, Steve, if you want to send me those resources, we'll actually attach those files to this class. That way you guys can check it out as students and continue the conversation. Because, you know, I 100% agree with Steve when Steve says, like, we just can't cover this all in 1 hour. And honestly, guys, the reason why I even started a real estate investing education company is because people started asking me. It was very similar. Steve and I were actually in a very similar scenario where they kept asking me questions, and I decided to, well, why don't I just create an education company around it? So a couple of last questions, Steve, and these are just things that are on my mind, and what I was planning on asking you beforehand. I know right now at the time of this recording, we're at around like the mid-year of 2019. I know there's been some changes when it comes to like selling and buying on contract.
Yep.
Do you have anything to say about those changes? I actually read up on, as weird as it sounds, Steve, I actually read up on the tax guide about 4 or 5 months ago, and I've actually enjoyed it. I didn't think I would, but I thoroughly enjoyed it.
You know what? When I met with you guys a couple weeks ago, we had some great conversations, and I was really impressed that pretty much the entire group stayed late because they wanted to hear more.
Yeah.
Everybody's biggest financial partner, it's not their spouse, it's not, their actual business partner, it's the IRS. And that's the partner we want to cut out of the deal as much as legally possible. We want to give them as little as possible so we can invest more.
Yeah.
So an ounce of planning is worth a pound of cure. If you come to me in April and ask a question about the previous year, there's not much I can do about it. What you want to do is you want to be proactive around the mid-year point. Check on your withholding. The IRS just updated the withholding tables again. So we want to take a look at our withholding to make sure we're not going to owe a ton. So we want to balance that out. We want to ask those questions. But you asked more specifically about seller financing and what's really changed. A ton really hasn't changed specifically. The biggest thing that we're really looking at is treatment of excessive interest in a business. So if you're buying from a business, we have a concern. Your other big things are we're going to be looking at depreciation, cost segregation, but from a grand standpoint, not too much really changed on those topics. Now, the nice part about seller financing, we also have what's called qualified opportunity zones. And this is a topic that I absolutely love. We have an ability to get creative with. It's also one of the reasons why I love business entities, because entities provide an extra layer and a little bit more advantage in some cases. But we want to run the numbers and make sure that it fits each individual situation. I also want to look at reducing audit chances as much as possible. So record keeping is incredibly important. Keeping your receipts, your bank statements are not enough, which reminds me we should actually record a session on record keeping requirements.
Yeah, absolutely.
I actually have an audit right now where the gentleman did not keep anything. Yes, I saw your eyes get wide there. He did not keep anything. He said, but it's all on my bank statements. Yes, but I don't know how you categorize those items from your bank statements. Can I just go through and mark with a letter what each one is? No, I need it on at least a separate worksheet by category. So the IRS agent, after he didn't follow my advice, gave him 10 days to go through his entire year of records.
Wow.
Before she was issuing a report. Now, from that report, he has 30 days to respond, but he's going to have some serious shock when he sees almost $1 million of expenses disallowing. But there's more. Because he didn't record keep, guess what the IRS agent did? Opened another year for audit.
Oh, wow. That's a headache.
That much more of a headache. So now he doesn't just have to go through 1 year in those 10 days. He has to go through 2 years. Combined, he's going to have about 40 days in total to go through both years of records. So he created an urgent problem by not taking my advice more than 8 weeks ago.
Yeah. Wow. Well, hopefully that happens to no one. Take heed, ladies and gentlemen, of Mr. Hamilton's words. Man. Well, hey, Steve, thank you so much for being on this section of our class here revolving around owner financing. Thank you so much.
No problem. If you have any questions at all, just let me know.
Yeah, and then I'll be sure to post your public resources on the side of this class and the attachment. So if you're a student.
I'm actually attaching them right now for you.
Perfect. Thank you so much. Appreciate it.
No problem. Take care.
See ya.